In February 2024, the U.S. equities market showed significant resilience and growth, influenced by the Federal Reserve's interest rate stance, the AI boom, and mixed small-cap performance. The Federal Reserve maintained its benchmark interest rate at 5.25% to 5.5% in January, extending into February, marking the fourth consecutive meeting. Rates remained steady. Despite market anticipation for rate cuts, Fed Chair Jerome Powell indicated more evidence was needed for inflation to sustainably move towards the 2% target. This cautious approach shifted market projections, with a higher likelihood of a June rate cut rather than the initially hoped for March cut. The Fed's decision was a reaction to macroeconomic figures, demonstrating ongoing economic resilience despite some subdued data. Inflation, measured by CPI and PCE, showed moderation but remained above the Fed's target, while strong employment numbers contributed to caution. U.S. equities moved lower after the Fed's January announcement, with the S&P 500 dropping 1.6% and the Nasdaq falling 2.2% on the day. However, February proved solid for equities, with the S&P 500 breaking 5,000 for the first time, reaching over 5,100, and ending the month up 5.17%. All 11 S&P 500 sectors gained in February, led by consumer discretionary and industrials. The relentless AI cycle continued to dominate, driving significant gains, particularly in large-cap technology stocks. Optimism surrounding AI fueled a global stock market rally, pushing U.S., European, and Japanese equity markets to all-time highs. NVIDIA, a key AI player, saw its stock rise over 28% in February, adding $275 billion to its market capitalization, nearing $2 trillion. The AI-driven supercycle fueled record capital expenditure and rapid earnings expansion, spreading across various industries. Investment in AI infrastructure, like data centers, is projected to be the largest infrastructure investment supercycle in modern history. AI adoption surged, with 65% of organizations regularly using generative AI in early 2024, nearly double from 10 months prior. This surge brought measurable benefits, including cost decreases and revenue jumps for businesses. Despite broad market gains, reliance on a few dominant large-cap AI companies presented a risk of downturn from earnings shortfalls. Small-cap stocks showed mixed performance in February 2024, with growth stocks leading at 8.1% return. The Russell 2000, a small-cap index, made a new 52-week high in February, but its year-to-date return was only 1.5%. Analysts noted small-cap earnings were in recession for the sixth straight quarter, primarily due to higher floating rate debt. Despite challenges, some analysts held a positive outlook for small caps, citing historically attractive valuations. U.S. small-cap stocks entered 2026 with valuations trading at nearly 25-year lows relative to the S&P 500, driven by the Fed's monetary easing pivot. The trajectory of interest rates remained a key catalyst for small caps due to their high prevalence of floating rate debt. A rotation of capital from mega-cap tech to value stocks and smaller companies was observed in early 2026. This shift saw significant inflows into small-cap focused ETFs, suggesting a growing belief in a rotation into small caps. In February 2024, professional traders experienced cautious optimism, balancing strong equity performance with underlying concerns. Economic indicators showed resilience and improving consumer sentiment, but geopolitical tensions and supply chain disruptions posed risks. The market's 2024 narrative balanced bullish factors like improved financial conditions against bearish indicators like recession potential. Traders closely watched earnings reports for insights into future estimates and margin pressures from rising wages and interest rates. The interplay between Fed decisions, AI evolution, and small-cap performance remained central to trading strategies in this dynamic environment.